banking and non-banking financial companies. We all know that financial institutions can be classified into two categories. First is banking and the second is non-banking institutions. In this lesson, we will discuss the types of banks, explain the types of mutual funds, describe the functions of insurance companies, define venture funds, and describe services provided by banks. After going through this presentation, you should be able to explain banking institutions in India, understand non-banking financial companies and RBI guidelines, discuss the types of services provided by NBFCs, analyze the development of financial institutions, define mutual funds and venture funds, describe the service provided by banks. The Reserve Bank of India is the central bank that is fully owned by the government. The central bank maintains the records of government revenue and expenditure under various heads. Commercial banks are banking institutions that accept deposits and grant short-term loans and advances to their customers. The commercial banks are also providing housing loan on a long-term basis to individuals. Commercial banks are of three types. These are public sector banks, private sector banks, and foreign banks. Next is development banks. Business often requires medium and long-term capital for purchase of machinery and equipment, for using latest technology, or for expansion and modernization. Such financial assistance is provided by development banks. Cooperative banks. People who come together to jointly serve their common interest often form a cooperative society under the Cooperative Societies Act. When a cooperative society engages itself in banking business, it is called a cooperative bank. There are three types of cooperative banks operating in our country. They are primary credit societies, central cooperative banks, and state cooperative banks. Exim Bank, SIDBI, and NABARD are examples of specialized banks. There are some banks which cater to the requirements and provide overall support for setting up business in specific areas of activity. Non-banking financial companies is a company registered under the Companies Act 1956 and is engaged in the business of loans and advances, acquisition of shares, securities, leasing, hire purchase, insurance business, and chit business. For regulatory purposes, NBFCs have been classified into three categories. First category is related to those accepting public deposits. Second is those not accepting public deposits but engaged in financial business. And third is core investment companies with 90% of their total assets as investments in the securities of their group or holding or subsidiary companies. As per the NBFC Acceptance of Public Deposit Directions 1998, the quantum of public deposit in respect of NBFCs was linked to credit rating from an approved agency so as to enable the depositor to make informed decision. The task force on NBFCs appointed by the Government of India submitted its report in October 1998, which recommended rationalization of regulations for NBFCs, improvement of the legislative framework for protecting the interest of depositors, and development of NBFCs on sound and healthy lines. There are several types of services provided by non-banking companies. These are hire purchase services. Hire purchase, the legal term for a conditional sale contract with an intention to finance consumers towards vehicles, white goods, etc. If a buyer cannot afford to pay the price as a lump sum but can afford to pay a percentage as a deposit, the contract allows the buyer to hire the goods for a monthly rent. Second is leasing services. A lease or tenancy is a contract that transfers the right to possess specific property. Leasing service includes the leasing of assets to other companies either on operating lease or finance lease. Third is housing finance services. Housing finance services means financial services related to development and construction of residential and commercial properties. Fourth is asset management company. Asset management company is managing and investing the pooled funds of retail investors in securities in line with the stated investment objectives and provides more diversification, liquidity, and professional management service to the individual investors. Next is venture capital companies. Venture capital finance is a unique form of financing activity that is undertaken on the belief of high risk, high return. Financial institutions play an important role in the Indian financial system. There are various kinds of financial institutions performing their role in financial intermediation and infrastructural development, differing on the basis of their inception and operations. IFCI Limited is the first development finance institution set up in 1948 under the IFCI Act in order to pioneer long-term institutional credit to medium and large industries. It aims to provide financial assistance to industry by way of rupee and foreign currency loans, underwrite or subscribe the issues of stocks, shares, bonds and debentures of industrial concern, etc. Its function includes merchant banking, leasing and equipment finance. SFCs are the state-level financial institutions which play a crucial role in the development of small and medium enterprises in the concerned states. SFCs have been set up with the objective of catalyzing higher investment, generating greater employment, and widening the ownership base of industries. It provides long and medium-term loan repayable ordinarily within a period not exceeding 20 years. State industrial development corporations have been established under the Companies Act 1956 as wholly owned undertakings of state governments. A mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. The money thus collected is then invested in capital market instruments such as shares, debentures, and other securities. A mutual fund is the most suitable investment for the common man as it offers an opportunity to invest in a diversified, professionally managed basket of securities at a relatively low cost. There are two major categories of mutual funds. First is closed-end mutual funds. These are the mutual funds where investment company cannot sell share units after its initial offering. Open-end mutual funds. Open-end mutual funds are commonly referred to as the mutual funds. The Unit Trust of India was the first mutual fund set up in the year 1963. In the early 1990s, the government allowed public sector banks and institutions to set up mutual funds. The objectives of SEBI are to protect the interest of investors in securities and to promote the development of and to regulate the securities market. Regarding mutual funds, the SEBI has broadly categorized mutual funds into three as Unit Trust of India, public sector and private sector mutual funds market, and offshore mutual funds. Insurance companies are in the business of assuming risk on behalf of their customers in exchange for a fee called a premium. Insurance companies make a profit by charging premiums that are sufficient to pay the expected claims to the company plus a profit. The insurance sector in India has completed all the facets of competition. The Indian insurance sector is growing at a very fast rate. The mechanism of insurance is very simple. There are two types of insurance. First is life insurance and second is non-life insurance. Venture capital is an important source of funds for technology-based industries which contribute significantly to growth process. Public issues are not available for such greenfield ventures. The term venture capital denotes institutional investors that provide equity financing to young business and play an active role advising their managements. Venture capital funds, VCFs, are part of the primary market. There are around 35 venture capital funds registered with SEBI apart from one foreign venture capital firm registered with SEBI. High degrees of risk, equity participation, long-term investment, participation in management, achieve social objectives, and investment is liquid are the main features of the venture fund. Venture capital firms finance both early and later stage investments to maintain a balance between risk and profitability. Services provided by NBFCs are fund-based services and non-fund-based services. The key types of fund-based services are overdrafts. All overdraft accounts are treated as current accounts. Overdraft accounts are kept in ordinary current account head of the bank branches. Second is demand loans. A demand loan account is an advance for a fixed amount and no debits to the account are made subsequent to the initial advance except for interest, insurance premium, and other sundry charges. Third is term loans. The term loan would be a loan which is not a demand loan and is repayable in terms, that is, in installments irrespective of period or the security cover. Fourth is cash credit advances. Cash credit account is a drawing account against credit granted by the bank and is operated in exactly the same way as a current account on which an overdraft has been sanctioned. Next is bill finance. Bills are either payable on demand or after usance period. The credit facilities given by the banks where actual bank funds are not involved are termed as non-fund-based facilities. These facilities are letters of credit, guarantees, and co-acceptance of bills or deferred payment guarantees. Guarantees issued towards disputed liabilities. Now let us check if we have understood the various concepts discussed in this lesson clearly. Non-banking financial institutions are financial institutions that provide banking services without meeting the legal definition of a bank. Right or wrong? Right. Leasing service includes the leasing of assets to other companies either on venture capital or finance lease. Right or wrong? Wrong. IFCI has played a key role in the development of cooperatives in the sugar and textile sectors. Right or wrong? Right. Before we end, let us briefly revise what we have studied so far. Financial institutions can be categorized in banking and non-banking financial companies. Banking includes commercial banks, cooperative banks, and other development and specialized banks. A non-banking financial company, NBFC, is a company registered under the Companies Act 1956 and is engaged in the business of loans and advances. Cash credit account is a drawing account against credit granted by the bank and is operated in exactly the same way as a current account on which an overdraft has been sanctioned. An NBFC cannot accept demand deposits. It is not a part of the payment and settlement system and as such cannot issue checks to its customers. Mutual funds can be described as open-ended funds operated by an investment company which raises money from shareholders and invests in a group of assets in accordance with a stated set of objectives. Banks provide different types of fund-based and fee-based services to its customers. A lease or tenancy is a contract that transfers the right to possess specific property.